Hey everyone, welcome back to another episode. And today we're going to be going over my thesis for S&P Global and whether or not I actually want to buy, sell, or hold this company. So let's go into what the core business for S&P Global is, right? They have about four different pillars that constitute its actual business. They have the rating system, which is going to be that grading on corporate bonds, grading on national bonds, right? We know that the US has a double A right now. So credit ratings are a big thing. Then it also has something called market intelligence, but which is essentially selling data to other companies and financial institutions so they can make better ideas on what they're buying, trading, and where they think prices are going to go. Indices. This is going to be like the S&P 500. It's going to be the Dow Jones. It's going to be like the S&P 400, S&P 600, S&P 700. Basically, the indices that everyone actually bases their performance and benchmarks it off of. Commodity insights is another item that's somewhat similar to market intelligence, where you're essentially selling information about commodities to traders and analysts and other people who are actually uh, producers of this to give them more idea for where their profits going to come, where headwinds might be, and other information that might be out there that people are willing to pay a premium to actually get information on. Okay, so let's start with the rating system. The rating is what they are mainly known for in the broader world. We all know about the rating system. If you pay attention to financials, you will know that their companies are rated double B or triple A. And that's going to be from S&P Global. I'm not sure which one they actually do. I'm not sure if they do the letterings or if they are the other system, which is one of them is Moody's, one of them S&P Global, but in essence, they do the same thing. They really rate the credit of debt issuers, and this can be things from corporations, it can be things like governments, financial vehicles, and that's going to be things like CMOs or mortgage-backed securities. And all of these things that they put their stamp on and they say essentially, are these items actually worth what they're saying they're worth? And how reliably are you going to get the cash flow from these products, from this company, from the issuer essentially? They also sell this research to people who want to use it. And it's not going to be like that stamping of it's not just the stamping of the label on it. For analysts, you can buy more information off S&P Global just to see where they actually get that research from. And so you have a deeper understanding of the underlying reason for why they give the label they give. The reason why the rating system is actually so well received from people is because of the large moat that have, well, the moat is part of it, but it's there because of the reputation, because of how great they've been at historically giving out these credit ratings. I think historically, when you look at the actual projection of whether or not companies are able to pay back in accordance to their S&P credit rating, it is actually a very, very high standard, and you will see that things that are rated AAA fail a lot less than things that are rated double A or double A plus, which have less failure rate than items rated double A minus, etc., etc. In addition, there is this mandated use of these ratings, partially because of that reputation from financial institutions. There are financial institutions that are obligated to have a portion of their financials in AAA rated bonds, or they have a restriction on how much low rated bonds they can hold, which would be high yield bonds or such what used to be junk bonds. And this is really ingrains S&P Global into that financial system, making it really hard to yank them out. Quite literally, it's probably impossible at this point to yank them out because of how much people rely on their research and their reputation to actually give a stamp of approval on credit ratings. So while they are more known for their credit rating system, they actually make most of their revenue, 35%, or a plurality of their revenue from market intelligence, which is selling research and analytics. Like I said, from all the previous things I've said, we are in a very, very big a very big driver of an environment. We are in a very big environment where a driver is an increasing need for data, and S&P Global provides a lot of data. They really help with the analytics and research, help financial institutions perform risk assessments. find opportunities, and actually assess their performance. What we're looking at here is like performance with regards to, hey, are we taking too much risk for what we're actually giving out? Are there opportunities that people are really aren't looking at? And this is the reason why the revenue is so high is because it is a subscription-based model and it's something, and because it's subscription-based, this revenue is always going to be recurring and it is the most steady part of S&P Global's revenue. And it's always a great thing to see that the largest portion of your revenue is the most stable because that means that fluctuations on the outside corners aren't going to impact you as much as otherwise could if the main core aspect of your company, of your revenue, is that fluctuating area of fluctuate. Yeah, with is if your main source of revenue is fluctuating, then it becomes a lot harder to predict where this company is going to go. So one of the other things that, one sec here. Sorry, I want to actually let you guys see what I was writing there, or what I actually typed there. But one of the other things, I'm combining indices and commodity insights because they aren't really as big at portions of S&P Global, but it is part of what they do. So indices, right? We all know about the S&P 500. There's also the S&P 400, S&P 600, S&P 700. Essentially, these are going to be talking about the indices that are we use as benchmarks as investors, as essentially even just essential benchmarks for how well we're doing as investment and benchmarks for the economy as a whole. And though the markets are not the economy, but these are essentially benchmarks that people peg themselves to and look at. So how they make money off of this is there's actually two portions. I only put licensing fees up here because that makes more sense to most people, but they also have asset fees. Essentially, as assets grow in price, they actually charge a bit more for licensing out or giving out the index with those assets in it. So it's a really important thing for a lot of you people right now, especially millennials and people who are jumping into that passive investing space. Because what are they pegging to, right? You're buying VOO or you're buying SPY and or VIOO or whatever, and essentially all of them are pegging themselves to these indices. And what these indices do is then give a portion of their revenue to S&P Global. And S&P Global is just supporting that type of passive investing and just people as a whole. They also have commodity insights. This is similar to the market analytics. However, this is more like have they're such an integral part of that system that they have become the benchmark data for commodities. They are what people look to when they want commodities data, and or one of the companies that people look to because there are other companies in this field, but they are one of the big ones in this area. It is the source of data that producers look at, that traders look at for, and analysts look at to see where the future commodity pricing is going to go, and using that to try to predict macroeconomic forecasts and macroeconomic headwinds, tailwinds, and see, trying to get ahead of what the next economic event is going to be. So with that being said, let's head over to the tailwinds I see from for S&P Global. Once again, increasingly data-hungry world. I'm going to ram this point down people's throats that the world as we know it is getting more and more data dependent. Whether it's AI, whether it's machine learning, we're increasingly wanting more data, and not just wanting more data. We want to know what the data means. And we also see AI as something that is going to help S&P Global because of their application of new AI methods and just historical existing machine learning applications to reinforce their moat, reinforce their historical reputation of being a great provider of insights. Expansion to private markets. Right now, what we can see is a lot of what I talked about has been about public markets. I've talked about market indices. I've talked about market intelligence, and all these are on the public markets. But there is definitely untapped potential in private equity, private credit, things that most people do not have access to, that S&P Global getting their foot in the door would reveal a giant market for them because that data, once again, just doesn't exist yet there. And the final point that I'm going to get hit up is monetary policy. It's going to, as the Federal Reserve wants to lower rates, that's actually going to be a tailwind for S&P Global. So let's take a look at the first one. Once again, increasingly data hungry world. We want more demand for information. They have great reputations about data. They have the analytics to tell you what does this data mean. They have all of this already in place, and they have such a high reputation that they are essentially what people look to as a source of truth. If you wanted to make a new model to actually show, okay, what is the rating of a company? S&P Global's rating system is that source of truth. If you wanted essentially to see, okay, what are predictions on a macroeconomic forecast? S&P Global is one of those sources of truth that people go to see, okay, this is where we should be, and they have such a high reputation that people are willing to pay a much higher premium for their information because of that reputation they have of being a source of truth in this environment. So AI and machine learning applications, right? This is going to enhance their product offerings. They can increase their moat with better models, improve efficiency with their existing models. And all of that really is ties into that previous point where I said that we are increasingly data dependent. We want more data, we want better data, we want more information, and we want something to tell us what this information means. So because of that, I think this ties in more so to the previous point than as a point by itself. Well, I do think this overall impact for AI and the machine learning applications is relatively low. However, the impact of a more data-driven, data-centric world is going to be a much bigger tailwind for S&P Global than I think most people actually expect. So and once again, we do see a third point here, right? Private expansion. A growth into private credit and private equity markets have historically been really opaque, and they are in position to really take advantage of this because of the expertise in already public markets. So they know how to get everything done in these public markets, and they can transition that into the private markets where where more people do want this information, right? Because how opaque that market is, you get a illiquidity premium, or you'll be able to charge a premium for that information because it's not data that everyone's going to have that information to. And those who are looking in that private market are trying to look away from the public markets, looking for new opportunities, which means they don't think that there is that opportunity in that. They think that there's less of an opportunity in the public versus the private, which means they should be willing to pay a bit more of a premium for that private information. I do think this impact is from medium to high level. I don't know where it is. I would put it at a medium 0.5 if I could, but that's not really a thing. So it's between medium and high because it is an area of expansion and increased revenue growth, but it definitely isn't as big, I think, as that demand in increased data. Finally, monetary policy. So as the Federal Reserve eases rates, this is going to be a boon for S&P Global. Why? It's because really you see these 3 points I have here. As the policy season, you have lowered interest rates, which means that companies are more likely to borrow more and restructure more. And by borrowing and restructuring, they have to go through S&P Global to essentially get their credit rated, to get their bonds rated. The reason they have to do this is because once the rating happens, you actually get you have a much lower required interest rate than if you just don't get it rated. This is simply due to the fact that you have less uncertainty about, okay, how good is this company actually? And being able to pay S&P Global to get maybe even $500 just for something like this label on this to get an interest rate that's 1 or 2 percentage points lower is well worth it for a company when they're taking out hundreds and millions of dollars of debt. That interest rate does stack on top of each other, especially if it is a relatively longer term debt. So more loans, more restructuring means more rating, means more revenue. In addition, more with an easing policy, right? People are going to look for a place where their money can make money. We don't want to put it into the risk-free uh, federal treasury-backed bills, right? So that means that there's more money into the markets, more money into assets, and as those assets increase in price, that increases the price of indices and allows for S&P Global to charge more asset-based fees on their indices. So I do think that this is more of a low to medium impact, maybe even just on lower side, simply because this easing policy isn't because of because there is economic strength, it's because we see economic weakness. And economic weakness is a big headwind for S&P Global's business model, as I'm going to touch on basically right now. So headwinds, you have economic headwinds, right? So economic conditions, as it worsens, people aren't taking out loans. People are being more risk averse, which means they aren't investing in the equity markets, meaning a lower return on the indices part of the business. And then reduced risk appetite reduction also means people are going to be taking out less loans. Regulation is also something that S&P Global does want to contend with because they are such an integral part of that financial system. The federal agencies are taking more looks at them and making sure that they're not doing anything untold for. Competition is also another one. Even though they are part of essentially a duopoly, they essentially are part of a duopoly with Moody's. I know Fitch is trying to get in there, but they're not really big enough to really count as a competitor. So let's actually head in and I'll dive into more details for each of these economic headwinds. So S&P Global essentially is tied really core tightly with the health of the economy. As the economy does better, people are willing to open up more businesses. As more businesses open up, they take out more loans to expand their business, which means S&P Global gets to rate more loans, rate more companies, and make profit off of that. As the economy does better, uh, as the economy does better, right, asset prices are going to increase because we have more money and companies get better and better. And as those assets increase, index pricing, right, you get more money off of that. And this is the issue. Well, it's great when economies are doing better. The same thing happens in reverse when there is economic uncertainty, when there's economic contraction. And this is looking like what might be happening in our near future as the Federal Reserve, while they are lowering interest rates, it's not because they've defeated inflation. It's because they see a issue with the job numbers. Therefore, it means that the economy is doing that great. And it is. So the next thing we do see that I have here is geopolitics lead to risk-off environments. So wars, conflicts, all of that mean people less wanting to take a risk, as you, and that means risk assets prices go down. Number of loans that are taken out goes down. Once again, reducing S&P Global's profits. Competition is not really that big a deal. I don't think this is that important. Fitch and Moody's are the two other rating companies, Bloomberg being market intelligence. S&P Global has really entrenched itself, and even with this type of competition, it's not really a concern for a company like S&P Global because in this space that they work in, it is a space where you provide information. And a lot of times, even if you do have a source of information from one company, it doesn't mean that you're not going to look for more information from other reputable companies, which means that customers of one are not exclusively customers of one. They can, the information are not pure substitutes. They're sometimes even just complements to one another. If you're getting Moody's data, you probably do also want some S&P Global data to make sure that what you're looking at is matching up to what you think. If you're getting Bloomberg market intelligence data, you want to get also S&P Global data just to make sure that what Bloomberg's saying makes sense. And if you are diverging from that Bloomberg data, you want to know, okay, am I actually in line with S&P Global? Are there people that think like me, or do I need to reevaluate everything that I'm looking at? So that's why even though there can be pretty large competition, I don't think competition is a very important headwind to consider when we talk about S&P Global. Regulations. Wow, we've been talking for a while now, but regulations after 2008, they've had higher oversight. This is a slight issue, but they have a really good reputation for this at this point. They do need to contend with the SEC, the fact that SEC can really rewrite the rules whenever they want, and they also need to have data safety regulations in there because of how much data they actually deal with, some of it being sensitive data, some of it not, but they want to have that in there. It's not really that important. It's definitely something that the company has been built up around, and it's not really something that is going to be harmful to the business in the future. If anything, regulation for this business is actually helpful because it expands that reputation of the company. And the implication that the company is not doing anything untold and anything suspicious, and they are giving out the best information that they possibly can. So, what is my overall thesis? I don't think the headwinds are any real concern for S&P Global, especially in the long run. In the short run, sure, we do see that weakening economy, and which means a lowering in risk appetite, which does reduce S&P Global's uh, margins a bit from the credit rating side. But I don't see that being sustainable long term. And if the company does actually trade down because of those type of fears, I am looking at opportunities to buy in. They have a strong ingredient, and that's undeniable. Anyone that is in the financial industry who actually talks about anything, who knows their salt, right? Knows about S&P Global and uses their rating systems. So what I see here, right, is probably acceleration of revenue in the short term due to lower rates. I know I didn't put this in here, but I do think that in the medium term, I do see a deceleration of revenue growth simply because of economic headwinds. And then finally, in the long term, I do see a sustained larger term, a longer secular trend of revenue growth. So what does that mean for me looking at the 5 year span? I think that the revenue, right? You guys can read this. I'm not going to say it all out to you, but I do think that the target price and the overall value for the company is around $500. When trading currently at 500, I think it is very fairly valued. I think everything on the upside has already really been priced in, and everything on the downside has been priced in properly as well, which means that we come out to a hold. Thank you guys for listening to my essentially rant about S&P Global. It's been 21 minutes. If you guys are still here, I love you guys so much. Leave a like if you enjoyed. Leave a subscription if you enjoy what I'm doing. And just let me know if there's other companies you would like me to do analysis on, and I'll try to get onto them. Thank you guys so much and have a great rest of your day.